Welcome to the CEFI Summit Europe, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the CEFI Summit Europe is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. Gather great market insight with over 120 speakers and 6 tracks to choose from. You are looking at Venture Capital, Technology and Entrepreneurship. Introducing
It's a great pleasure to be in Paris today speaking to this CEFI conference. What I'm going to do in this session is to explain how AIM, the London's Stock Exchange's growth market, can actually fulfill the capital raising needs of Europe's innovative companies. I'd like to structure my remarks in a fairly simple way. First, I'm going to outline how AIM began, which was over 10 years ago, and how it overcame huge early skepticism. Secondly, I'll outline some of the key features of the market which actually make it so successful. Thirdly, I'll show how AIM has been developing recently before offering some reasons why it offers the growth market solution that Europe so badly needs. So, if I look at the background and the origins of AIM, many, many years ago, what AIM was about was setting up a new market for smaller growing companies with a regulatory environment which was actually suited to the needs of those companies. And that clearly is not an easy task, because you have to make sure you have the right balance between a highly successful market with great standards of integrity, but also a market which is suited to the needs of smaller companies. We were told at the time by just about every financial commentator that this project was doomed from the outset. So it's incredible I'm here today. Apparently we were being far too ambitious. One commentator said there were strong doubts that we would be able to attract institutional investors. I'll explain what happened to institutional investors later. The Financial Times, the august Financial Times, said, "Pity the London Stock Exchange. If we keep the regulatory burden low, shareholders won't invest. But if regulatory standards are too high, small companies will decide it's not worth the effort or the cost." And that's the fundamental issue about you have to get that balance right to make the market work. Encouragingly, one national newspaper said 2 things could happen. Either AIM would fail immediately, or it would die a long, slow, agonizing death. It reminds me actually of the old joke. Why did God create market commentators? Any answers? In order to make weather forecasters look accurate. Creating a brand new market is as difficult as making the prediction about whether it will succeed or fail in actuality. But we knew that the basic premise that providing smaller companies with access to equity finance with a market structure suited to their needs was clearly going to be a winner. And in the UK in the early 90s, we have many smaller but dynamic entrepreneurial companies, very similar to Europe at the moment. And they were being denied access to the funds they needed to grow and develop. And the banks weren't always able or willing to provide the necessary funds at a sufficiently low cost. So often bank finance is prohibitively expensive or non-existent, as many of you can probably attest to in this room. And also many smaller firms are finding it very hard to seek a full main market listing because they were too small and they couldn't meet all the regulatory obligations. So there was obviously a very big gap between early stage lending from banks and private equity and a full listing with all the compliance and regulatory requirements that go along with that. So our brief was to offer smaller companies across all industry sectors the opportunity to raise capital, but importantly on a market with a pragmatic, I would say intelligent approach to regulation that was appropriate to their needs. So it's from that background that AIM was born. And AIM began life as the alternative investment market, owned, operated and regulated by the London Stock Exchange, but a very clear alternative to our main market. Now, both share some quite significant attributes. Both have got high quality trading systems. Both have access to London's international investment community, which is the most international investment community on earth. Both give global visibility. And the main market, I suppose, supports the capital raising activities of established companies who are seeking to move on to the next stage of growth, whereas AIM really is geared specifically to the different needs of smaller growth companies. So we thought having a market which could provide smaller, innovative companies with growth capital wasn't only a benefit to the London Stock Exchange, it's got a far wider, or it has and still does have a far wider political and economic imperative. Without strong growth markets, it's difficult for any government to promote enterprise and develop a healthy equity culture. And I think that's a huge issue for continental Europe at the moment, particularly when we have the growing threat to places like India and China. I spent last week in Mumbai, and it's incredible the energy and enthusiasm, skill and entrepreneurialism of these kind of countries. And if we don't wake up to that, we're going to find ourselves in a banana republic in Europe, and that isn't... I chose my words deliberately. We do need to wake up to that fact. So trying to help finance smaller entrepreneurial companies, the people that will drive economic growth, is fundamentally important to Europe. And our government in the UK has realised that they had to support AIM's regulatory structure, and they gave some targeted tax incentives to investors to actually encourage investment in smaller companies from the start, and that's been very helpful. And they're bigger incentives than you get on the main market. And that's established an enabling environment in which AIM's actually flourished. So those were the origins of AIM. It was a very difficult balancing act at the start, but the reasons for the existence of AIM were crucial to the economy, to close that gap between early stage finance and companies on a main market. When it was launched, I think there was no doubt that AIM was the stock market with the most straightforward admission process of any market on earth, the least bureaucratic process. It remains that way today, which I think is important to say. If you look at our requirements for AIM specifically, there's no minimum shares required in public hands. Unlike the main market, we have to have at least a 25% free float. There's no trading record requirement, unlike the main market, which is 3 years. There's no minimum market cap. There's actually no maximum size for an AIM company, but it does tend to attract companies of a size of between 5 and 100 million euros. The average is around 50 million euros. You haven't got to be incorporated in the United Kingdom to be on AIM. You don't have to restate any historic accounts, which saves a lot of money and removes benefits to accountants. You don't have to have prior shareholder approval for many transactions. So once you get onto that market, you retain a huge amount of flexibility. And because of that unique admissions procedure, AIM attracts younger growth companies that have far shorter trading histories. You could say that AIM is where smaller companies actually learn about becoming a fully listed company, where they evolve into that state. However, I think it's important to say there is a huge difference between lighter regulation and no regulation. As I said at the start, we have to protect investors and ensure market integrity. And as we've grown AIM, we've kept the same basic structure, but we've actually continually improved the standard of regulation. AIM companies are required to appoint specialist advisors who ensure that the companies are appropriate for the market. Now, these specialist advisors are called nominated advisors or nomads. When I go to China and talk about nomads, people get very confused. So I have to say nominated advisors. They carry out the pre-vetting to assess a company's suitability to join AIM, and they're on hand throughout a company's life to make sure that they deal with any ongoing market-related issues. The nomad with the company prepares an admission document which includes all the relevant information on the company and its activities. So obviously that includes things like financial information and any projections, together with details of the directors. Now, like having the least bureaucratic entry process of any market on earth, the rules we have on AIM are also tailored to the needs of smaller growing companies. We've only actually just got over 40 rules for AIM. They're very clear and concise. They're drafted, you'll be delighted to know, non-technical language, so they can actually be understood. They're meant to be understood. And they're mainly about disclosure, because standards of disclosure on AIM have to be as high as on the main market. A company can then join AIM when the nomad says it's ready. You only have to give the exchange 10 or 20 days notice, depending on the type of transaction. And being in control of that notice period actually is crucial sometimes for smaller companies, because sometimes there are quite small windows when it's best to raise capital, when it's time to float. So